They're out of money. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, McDonald's just dropped a bombshell warning. I'll show you what the big fast food giant just said and why it's an ominous warning for consumers and businesses all over the world. And one major company just announced the unthinkable. I'll show you why its employees are outraged and why employees from major companies all around the country are soon to be outraged as well. And our investors on the wrong side of this market, I'll show you why this one labor market indicator says yes. Plus, we have a sponsor for today's show. I'd like to welcome Relied Technology to the show. You can find them on the NASDAQ under symbol STI, and their solid-state battery platform could transform the entire EV space. And their stock right now is in the early stages of a swing trade setup. You might remember the other day we featured a company in the same situation. We said the stock would go up 27%, and the next day it took off, making those who got in a bunch of money. We think that Relied Technology stock could go up by as much as 15%. Stay tuned to the end of the show or check out the pinned comment for more information. Now let's over to Bloomberg, where he picked today's story up with a headline, "As McDonald's sales fall short on international weakness." And this is a dangerous sign because everybody's now getting excited about the soft landing scenario. They think the Federal Reserve's 50 basis point cut is all the economy needed. And this means that U.S. consumers would increase demand and start to pull the global economy out of its downward trend. But what we're now seeing is the exact opposite, where things overseas are getting weaker and domestically, well, they're not that great at all. Sales at restaurants open at least 13 months fell 1.5%, worse than analysts had projected. The U.S., however, was a bright spot with growth of a mere 0.3%. Now, keep in mind, these numbers are not inflation adjusted. So again, according to inflation, McDonald's actually saw a decline in sales. And what this starts to tell us is that everything we know about the U.S. consumer and the global consumer is true, and that is they're running out of money. Demand is falling because people just do not have the hours or, of course, the income to continue to spend on eating out, particularly when inflation is still running relatively high. We know insurance costs are up, and we know, of course, debt service costs are high as well. And this is a dangerous sign for the global economy because one of the first signs of a turnaround happens to be when consumers start eating out again. And McDonald's has been working to reverse traffic declines in all its geographic segments, driven by consumers' reticence to spend, high levels of inflation, and boycotts against American brands in the Middle East. But the real issue here is that consumers can't afford higher prices. And we noted that when McDonald's came out with their promotion many months ago, we said that there's no way they were going to cancel it, even though McDonald's said, no, this is a temporary promotion. We said, not a chance, because we're seeing trends where total household incomes continue to fall, and that means, of course, prices at fast food restaurants need to come down as well. And efforts have included a value push around the world, including a $5 meal deal in the U.S. and a limited time release of vintage McDonald's cups. What all suggests is it's not enough to lure consumers back in a big way. As we see now, total sales across franchise and company-owned restaurants were flat, and that's not a good sign because costs have gone up, and this is a challenge for employers who are then going to be forced to cut hours or look to further automation to continue to maintain their profit margins. But we see this trend is likely to get worse because when we look at labor market, we see, of course, in the form of total incomes, we look at average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, this shown in red, against real retail sales for food services. Again, this is inflation adjusted, that's in blue, and they're both shown on a year-over-year rate of change. So what we see here is as income started coming down around 2022, what did we see? A big drop-off in demand for food services. Now the year-over-year rate of change, even though it was negative, increased a little bit, but still remained negative as total incomes continue to fall. Now McDonald's is saying, well, things have flattened out, and that's a good sign. Well, that's because total incomes have flattened out as well. But if we start to see further cuts in hours worked, or we see income growth start to slow even more, what it suggests is McDonald's is going to see a further decline in their sales, and that's not good because we look around the world and we see those trends persisting. We go back to the global financial crisis, we see the same exact trend happen, even going into the dot-com bubble, and even back, of course, what was considered then a soft landing in 1994. But so far, looking at restaurants, the trend here isn't good at all. But now let's talk about one major company's change that now has all of their employees outraged as Starbucks threatens to fire staff who don't come back to the office. And this is something we warned about when Amazon was going to do this and they put out the announcement. It was all done to get people to quit, because now employers are on the side of the market where there is plenty of available workers on the unemployment line, so they don't have to actually give away too much, and they can command their employees come back to work and simply say, if you don't want to come back, we'll find a job elsewhere. And starting in January, Starbucks will implement a standardized process to hold workers accountable if they don't abide by the coffee chain's return to office policy. And consequences for those who don't come back could be up to and including separation. And you think about why companies like Amazon and Starbucks want people to come back to work. Because why do people go and get coffee? Well, a lot of times it's because they're on their way to work, or maybe they're at work and they'd like to go get one. So Starbucks is a huge benefactor of course, the return to office movement. They want to support that. But the big change here is that employers are realizing that they can make people come back to work, and if they don't, they can fire them. And the beauty part of this for employers is they don't have to pay unemployment benefits if people voluntarily quit. Of course, the change now again has turned to the tide of employers, and employees, of course, now we see are absolutely outraged. But this trend that we saw start with Amazon and now is at Starbucks is going to go to a lot of other employers, and what we're going to see is employees all across the company completely outraged. But one trend we see heading higher, and that is the stock for our sponsor for today's show, Relied Technology. You can find them on the NASDAQ under the symbol STI. Now, a swing trade begins when you get a full candlestick close above the 9-day moving average. It has to be rising in trend. We see the 9-day hidden underneath here. It's rising. You see the full candlestick close. The stock has rallied since then, and you look the other day, it jumped upwards of over 44 cents and did that once before. We're seeing here what is a potential repeat of that move would be a 15% potential return on the stock. Stay tuned for more information on Relied at the end of the show, because while Starbucks is the latest company to shift from carrot to sticks in the ongoing return to office battle that has been playing out at workplaces, we now see that last month Amazon Chief Executive Officer Andy Jassy surprised employees with a memo ordering them to start reporting to their desks 5 days a week, also beginning in January. Amazon currently lets many of them work from home 2 days a week, and that's over. And earlier this year, Dell Technologies told workers to choose to remain remote that they wouldn't be eligible for promotion, and Wall Street banks have also warned that working from home could jeopardize employees' career prospects. Still, offices in the biggest U.S. cities remain half empty compared to their pre-pandemic levels. And this again is a big issue. You want to create demand for your products and services. You need to get workers back in vehicles, back into the office space. And believe me, companies like Dell and Amazon and Starbucks, they're all concerned about what would happen if we don't see a return to work. They've got big investments in office spaces. They've got retail locations. They need people to go back to work. And you're going to continue to see a big push in this, something that I believe could happen during the next recession. The government could offer incentives to companies if they see a big number of their employees come back to the office. I know many people are outraged. Love to know what you think. Write in the comments below. If your employer said come back to the office, would you be outraged? Would you quit? Or would you go back? But let's talk about U.S. job openings. There's a question now, are investors on the wrong side of the trade? Well, this one indicator is now telling us absolutely, as job openings declined to the lowest level since early 2021. And available positions decreased to 7.44 million from a downwardly revised 7.86 million reading in August. And this is notable because Wall Street's been betting big, and we see investors going all in on a Republican sweep, believing that the labor market is strong and robust. But wait till I show you what consumers are saying about this, because they're not seeing what's actually going on in the economy. We now see employers cutting job openings, and this is one of the first signs before they cut hours and then before they cut jobs. And this is a dangerous sign because job openings have been on a downward trend for the most part of 2 years. And this report showed vacancies declined broadly across industries. The number of layoffs rose to the highest since January 2023, while fewer workers voluntarily quit their jobs, and for good reason, because there aren't a lot of other jobs out there. That's what we've been noting. Before, it was to their advantage to switch jobs. They would get a bigger pay raise. Now the risk is at the bottom of the totem pole, and employers aren't looking as much. And that's a sign of less confidence in their ability to find a new job, which is really interesting when we look at consumer confidence here in a little bit. Because when we look at job openings against the unemployment rate, it makes perfect sense. As more people hit the unemployment line shown in red, well, that means employers are cutting job openings shown in blue. And you can see what is a near mirror relationship here. But over the last 2 years, we've seen a large decrease in job openings. We haven't seen a big increase in the unemployment rate. But while the Fed says they think the unemployment rate is peaked, in our view, this is only the beginning of where the unemployment rate is headed. Other indicators point to a still strong labor market and economy, and I'm baffled by what they're suggesting here, because this has prompted traders to pare back bets that the Federal Reserve will opt for another big interest rate cut next week. In all likeliness, the Fed's only going to cut about 25 basis points because they are still going to cut. And the JOLT survey, well, it tells us they are. But let's take a look at the JOLT survey, still shown in blue, against the federal funds rate in red. And what can we see? As the labor market starts to decline, as job openings get cut, the Fed certainly reacts. But what I want you to know is that as the Fed cuts rates, it doesn't change the trend of the labor market. You see here, going to the pandemic, the Fed was cutting as the JOLT survey rolled over. And now, look, the Fed has been ignoring the JOLT survey, hoping for a turnaround. If there's any question, there's going to be a cut next week when the Fed meets. Probably not 50 basis points, but they're likely to cut. But are investors on the wrong side of the trade? Well, when we look at the NASDAQ 100 against the JOLT survey, what you can see is as there's a decline in job openings, usually that is bearish for the stock market. You see that trend happening here. And how about going into the early stages of 2022? The JOLT survey went down and the stock market reacted correctly. But then all of a sudden, investors said, we don't care if job openings go down. We don't care because we think the labor market is going to turn around. We think the economy is going to boom. And they bought in a big way, and yet you see the JOLT survey continue to trend down, suggesting that investors are indeed on the wrong side of the market. But let's talk about consumer confidence, because it bounced back, and this is a bit of a shock as consumers regain faith in the U.S. economy. We saw the Conference Board indicator rise to 108.7 from 99.2. Let's look at some of the details here, because consumer confidence recorded the strongest monthly gain since March of 2021, but still did not break free of the narrow range that had prevailed over the last 2 years. In October's reading, all 5 components in the index improved as consumers' assessments of current business conditions turned positive. Their views on current availability of jobs rebounded, which is shocking as employers cut jobs, which is potentially reflecting a better labor market, or that, of course, employees are a bit delusional about the direction of the economy. They could be focused on the stock market and not focused on the real underlying data of what's happening. The proportion of consumers anticipating a recession over the next 12 months dropped to its lowest level since the question was first asked in July of 2022, as did the percentage of consumers believing the economy was already in a recession. In fact, consumers became more upbeat about the stock market, as 51.4% of consumers now expect the stock market to increase over the next year, which is validating why we're seeing this major push as investors are going all in even more in the mega cap 7 here. The highest reading now since the question was first asked in 1987. So here we see investors are mega bullish. At the same time, the JOLT survey is saying, wait a minute, the economy is going in the opposite direction, but nevertheless, investors are saying, no, we think the stock market's right. We think the economy is going to boom here. In fact, only 23.6 expected stock prices to decline. The share of consumers expecting higher interest rates over the 12 months increased to 47.5 after declining for 4 months in a row, which is validated by what is considered the Republican sweep of the market's pricing in here, higher interest rates, which is why we're seeing bonds sell off and investors short the bond market, and rising equity prices as everyone goes all in, again, on the mega cap stocks. But let's talk about, of course, consumer confidence here, because what doesn't make sense is when you see job openings decline, as we did going into the global financial crisis, it usually means that, according to the University of Michigan's Consumer Sentiment Survey, the confidence goes down. You see that sort of happen here again right around late 2018 as we see the JOLT survey start to trend down and confidence flattens out. But look what happens in 2022. You see the JOLT survey on a big decline, and investors are saying, no, we're more confident than ever. And yet it doesn't make any sense, because when the labor market goes, well, that means confidence is going to plummet, as well as stocks. Because now when we look, of course, at the NASDAQ 100, now shown in blue, against the University of Michigan Consumer Sentiment Survey, we see that when stock prices go down, confidence goes down. Makes perfect sense. Right now, what's driving consumer confidence? It's not the economy. It's not the labor market. It's the stock market, and we know that bubbles can go for a while, but they do eventually burst. And something that's bursting is hopes for Ford as they now trim their profit forecast over cost and hurricane disruption. But the issue for Ford has to do with Morgan Stanley's recent call that downgraded Ford on Chinese supply and rising delinquencies. Another red flag here that consumers are running out of money, and that's validated again by Crocs as shares sink after the shoemaker pares back sales outlook. So again, we continue to see signs the economy is slowing, and yet consumers and investors are bullish as ever on stocks. As Crocs sales growth in the third quarter, which included the crucial back-to-school shopping period, remained flat. And again, it's not inflation adjusted. They're hoping that their 2024 sales growth will hit 3%, the low end of its prior guidance of 3% to 5%. Keep in mind, again, these numbers are not inflation adjusted. But something we're bullish on, and that is the stock for our sponsor of today's show, Relied Technology. You can find them on the NASDAQ under symbol STI. Let's take a look at the company, and then we'll look again at that chart and that early swing trade setup that could generate a potential 15% return. All the information in the pinned comment and description below, because what if electric vehicle battery materials could be derived from renewable sources? What if nickel and cobalt could be replaced with readily available abundant materials? Let's talk about green graphite, because it's a synthetic graphite derived from biomass. It's less costly than petroleum coke, less impact on the environment, and it mitigates climate change. Graphite makes up 25 to 28% of an EV battery. There are only 2 natural graphite mines in the US, and again, this is all made in America. As we talk about the next-gen cathode, which has high-capacity sulfur cathode materials. There's no need for nickel, cobalt, or manganese. There's exceptional specific energy, lower costs than conventional solutions. As I mentioned, it's made in America. The Relied Technology story, well, let's talk about how they have an impressive intellectual property portfolio holding over 525 patents globally, with 355 in the United States and 170 in various foreign jurisdictions. The collection of patents originating from HPC and G3 covers the next generation battery technologies. Notably, has gained recognition by winning the prestigious R&D 100 award in 2018 for their silicon anode material, testament to their innovation. Now let's talk about their solid state battery. Its energy density has 20 to 80% increase in EV driving range. Its solid state performance could see its batteries available in 2 to 3 years. It's safe as it provides an effective solution to battery fire and explosion issues, as a lower cost per kilowatt hour and faster recharge. And when we compare the performance of today's lithium IM2 Relied Technologies platform, we see massive improvements across the board in pack volume, pack energy, range, charge, power, and safety. And this again is made in America behind the movement of the Inflation Reduction Act. By 2026, 80% of battery materials must meet these content requirements. Now let's take a look at some of the recent press releases, as Relied silicon composition is on par with silane gas-derived Si at a substantially lower cost to EV manufacturers. And Relied has overcome these technical obstacles at its Dayton, Ohio facility manufacturing silicon anode materials. Relied's innovative Si anode technology has been recently validated by third-party testing, which confirms that Relied's silicon anode materials provide comparable performance to the best performance of any other silicon anode materials. As Relied granted 20 patents on the next-gen batteries by the U.S. Patent and Trademark Office during the first 8 months of 2024, the significantly expanded IP portfolio further solidifies Relied's leadership position in solid-state and other advanced battery technologies. They're on a tear, and something we think is also going to be on a tear is their stock. Let's take a look again at that swing trade setup. What you're looking for is a rising 9-day moving average shown in orange and a rising candlestick close. We get that confirmation here that the swing trade has begun. The stock has rallied, and including a couple days ago where it shot up by more than 15%. We see another potential move here, and we see this happening before, setting up again a potential 15% move in Relied Technology stock. Again, you can find them on the NASDAQ under the symbol STI. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.